ExamPrep.School. Virginia Life and Annuities Insurance Exam, exam code SERIES 11-5. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Annuities. Federal tax considerations for life and annuities. General insurance. Insurance regulation. Life insurance basics. Life insurance policies. Policy provisions, options, and riders. Qualified plans. Virginia annuities and suitability. Virginia life insurance laws and rules. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following is an example of speculative risk rather than pure risk? A. An investor purchases commodity futures hoping for price appreciation but risking financial loss. B. A manufacturing plant faces potential loss if its machinery is damaged by an accidental fire. C. A homeowner worries about incurring medical expenses after being exposed to a contagious disease. D. A company installs a sprinkler system to reduce the chance of fire damage to its warehouse. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is A. This option depicts an activity where there is a possibility of gain or loss, which is characteristic of speculative risk. Pure risk involves only the chance of loss or no loss. Reason B is not correct. This scenario involves only the possibility of loss, which defines pure risk. Reason C is not correct. This situation presents only the chance of a loss, medical expense, typical of pure risk. Reason D is not correct. This describes a risk control measure rather than an exposure to risk. Question 2. A manufacturing facility stores flammable solvents next to an electrical control panel. In this scenario, which of the following represents a hazard? A. Fire engulfing the plant. B. Storage of flammable solvents adjacent to electrical equipment. C. Explosion of the solvents. D. The electrical control panel itself. The correct answer is B. This option correctly identifies the storage of flammable solvents as a physical hazard that increases the probability of a loss. A hazard is a condition that raises the chance or severity of a covered loss, whereas a peril is the actual cause of the loss, such as fire or explosion. Reason A is not correct. This describes a peril, the actual cause of loss rather than a hazard, which is a condition that increases loss probability. Reason C is not correct. This option is a peril, the cause of loss, instead of a hazard condition that raises the chance of loss. Reason D is not correct. The control panel is normal property rather than a condition that increases the likelihood of a loss. Question 3. Which type of insurer is incorporated outside the United States but authorized to transact business in Virginia? A. Domestic insurer. B. Foreign insurer. C. Alien insurer. D. Reciprocal insurer. The correct answer is C. The correct answer is an alien insurer because it is incorporated outside the United States, yet legally authorized to write business in Virginia. Reason A is not correct. A domestic insurer is incorporated in Virginia, not outside the United States. Reason B is not correct. A foreign insurer is incorporated in another U.S. state, not abroad. Reason D is not correct. A reciprocal insurer is a type of exchange organization not defined by its jurisdiction of incorporation. Question 4. A Virginia surplus lines broker is asked to place specialized flood insurance with an insurer that holds a valid license in Maryland, but lacks authority in Virginia. Under the distinction between admitted and non-admitted insurers, which obligation must the broker fulfill before binding coverage? A. Obtain a surplus lines affidavit showing coverage was unavailable through admitted insurers and remit the required surplus lines tax. B. Obtain prior approval from the Virginia DOI by filing the insurer's policy forms and rate filings before binding coverage. C. Verify that the insurer participates in the Virginia Life and Health Insurance Guarantee Association to secure policyholder protections against insurer insolvency. D. Inform the client that as a non-admitted insurer, the company is not subject to any state regulator's financial solvency oversight or rate filing requirements. The correct answer is A. The correct answer is that a surplus lines broker must secure an affidavit demonstrating that the risk could not be placed with an admitted insurer and then pay any applicable surplus lines premium taxes before binding coverage. Reason B is not correct. Filing policy forms and rates for approval is required of admitted insurers, not surplus lines placements with non-admitted insurers. Reason C is not correct. Non-admitted insurers are not covered by state guarantee associations. Verifying participation in one is irrelevant to surplus lines compliance. Reason D is not correct. Non-admitted insurers remain subject to solvency oversight in their state of domicile, and brokers cannot advise clients that they are entirely exempt from regulation. Question 5. Which of the following actions by an insurance agent constitutes implied authority from the insurer? A. Advertising premium rates in a local newspaper only after obtaining written authorization from the insurer. B. Settling minor claims on the insurer's behalf without explicit instructions when such settlements are customary. C. Issuing a temporary coverage binder in writing upon receiving an oral directive to do so. D. Assigning a life insurance policy to a beneficiary as designated in the insurer's policy file. The correct answer is B. The correct answer is the one that involves actions not expressly granted but reasonably necessary to carry out agency duties. Settling customary minor claims falls under implied authority. Reason A is not correct. This describes express authority because it requires written authorization before acting. Reason C is not correct. This reflects express authority since it follows a direct oral instruction to issue a binder. Reason D is not correct. This example involves carrying out a specific recorded instruction and thus is express authority. Question 6. An insurance producer in Virginia collected policy premiums and deposited them into a commingled personal checking account, occasionally using funds for personal expenses and waiting several weeks before remitting to insurers. Under Virginia statutes governing fiduciary duty and premium trust accounts, which action should the producer have taken? A. Deposit all premiums into a designated premium trust account by the next banking day after receipt. B. Maintain premiums in a personal account up to a specified limit before transferring them to insurers' accounts. C. Consolidate premiums and forward them to insurers at the end of each month to ensure accuracy. D. Use funds in the premium trust account for personal expenses after providing monthly reconciliation reports. The correct answer is A. The correct answer is that premiums are fiduciary funds that must be held separate from personal funds in a premium trust account and deposited by the next banking day to comply with Virginia's regulations. Reason B is not correct. There is no allowance for holding premiums in a personal account up to any limit. All premiums must be segregated immediately. Reason C is not correct. Remitting premiums only at month end violates statutory timing requirements for prompt deposit into the trust account. Reason D is not correct. Using trust account funds for personal purposes is strictly prohibited, regardless of reconciliation reporting. Question 7. When applying the human life value approach to determine an individual's insurance needs, which of the following component sets is used in the calculation? A. Asset accumulation, retirement needs, and mortality factor. B. Gross future earnings, inflation rate, and tax rate. C. Present value of family dependency ratio and outstanding debts. D. Net future earnings, personal consumption, and discount rate. The correct answer is D. The human life value approach estimates the present value of future net earnings by subtracting personal consumption and discounting the remainder using an appropriate rate. Reason A is not correct. Asset accumulation and mortality factors are unrelated. The approach measures economic loss from lost earnings. Reason B is not correct. This approach does not combine gross earnings with inflation and tax rates. It focuses on net earnings after personal consumption. Reason C is not correct. Family dependency ratios and debts are not components. The method centers on future earnings, less personal needs. Question 8. Under the needs approach, which of the following expenses is classified as an immediate cash need at the time of death? A. Long-term educational expenses for children. B. Funeral and burial costs. C. Future retirement income for spouse. D. Ongoing mortgage payments. The correct answer is B. Immediate cash needs include expenses such as funeral and burial costs required at death. Other listed items are funded through separate future needs categories. Reason A is not correct. Education expenses arise in the future and are not immediate cash needs at death. Reason C is not correct. Retirement income is a future income need rather than an immediate expense. Reason D is not correct. Mortgage payments are periodic obligations, not lump sum cash needs at the time of death. Question 9. Which life insurance planning approach best addresses John's objective? A. Income replacement approach. B. Capital retention approach. C. Estate conservation approach. D. Business continuation approach. The correct answer is A. The correct answer is the income replacement approach because it provides a defined stream of payments to replace the insured's earnings for a specified period, matching John's goal of maintaining his family's living expenses for 15 years. The capital retention approach focuses on preserving principal indefinitely. The estate conservation approach targets funding estate taxes and expenses, and the business continuation approach supports business succession needs. Reason B is not correct. This approach preserves principal to generate ongoing interest indefinitely rather than providing a time-limited income stream. Reason C is not correct. That approach is designed to fund estate taxes and settlement costs, not to replace lost income for living expenses. Reason D is not correct. This approach funds business succession agreements and is not focused on personal family income replacement. Question 10. In a cross-purchase buy-sell agreement among business owners, which of the following best describes the typical life insurance funding arrangement? A. Each owner holds a policy on their own life, naming the business entity as beneficiary to provide funds for future buyouts. B. The business entity purchases and owns policies on each owner's life, paying all premiums and using proceeds to buy a deceased owner's interest. C. A trust established by the company acquires the policies, with each owner contributing funds in proportion to ownership percentages. D. Each owner individually purchases and owns policies on the other owner's lives, paying premiums proportional to each owner's equity interest. The correct answer is D. The correct answer is that in a cross-purchase agreement, owners individually own policies on each co-owner and pay premiums so that surviving owners use the proceeds to acquire the deceased share. Reason A is not correct. Involves owners insuring themselves with the company as beneficiary, which is not how cross-purchase agreements are structured. Reason B is not correct. Describes an entity purchase structure, not a cross-purchase arrangement. Reason C is not correct. Refers to a trust-based funding method rather than direct cross-purchase ownership by each owner. Question 11. Which feature correctly identifies an entity purchase buy-sell agreement funded with life insurance? A. Individual owners own insurance on each other, pay the premiums, and directly receive proceeds upon a triggering event. B. The business entity acquires and owns policies on each owner's life, pays all premiums, and uses death benefits to purchase the deceased owner's equity. C. A corporate trust holds the policies, with owners contributing funds in proportion to their ownership percentages. D. Each owner purchases coverage on their own life, naming the business as beneficiary to enable future equity acquisitions. The correct answer is B. The correct answer is that in an entity purchase agreement, the business itself owns each policy, funds all premiums, and uses benefits to buy the departed owner's share. Reason A is not correct. Describes a cross-purchase structure where owners insure each other directly. Reason C is not correct. Reflects a trust-based approach, not a direct entity ownership method. Reason D is not correct. Involves owners insuring themselves rather than the entity owning the policies. Question 12. Precision Tools, Inc. purchases a $1 million life insurance policy on its chief engineer, with the company as owner and premium payer. Premiums are paid with pre-tax corporate dollars. Upon the engineer's death, Precision Tools, Inc. receives the full benefit. Which statement best describes the tax treatment of the premiums and death benefit? A. Premiums are deductible as a business expense and the death benefit is taxable as ordinary income. B. Premiums are deductible as a business expense and the death benefit is received income tax-free. C. Premiums are not deductible and the death benefit is received income tax-free. D. Premiums are not deductible and the death benefit is taxable as a capital gain. The correct answer is C. The correct answer is that key person insurance premiums are not deductible by the business, and death benefits paid to the policy owner are received income tax-free under the Internal Revenue Code. Reason A is not correct. This incorrectly treats premiums as deductible and death benefits as taxable. Key person premiums aren't deductible, and benefits aren't taxed as income. Reason B is not correct. This implies that premiums are deductible, but key person insurance premiums are disallowed as a business expense even though benefits are tax-free. Reason D is not correct. Death benefits under a life policy are not taxed as capital gains. They are received income tax-free. Question 13. Which persons must sign the applicant signature section of a standard individual life insurance application when the policy owner is not the proposed insured? A. Proposed insured only. B. Policy owner only. C. Proposed insured and policy owner. D. Proposed insured and beneficiary. The correct answer is C. When the policy owner and proposed insured are different individuals, both must sign the applicant's signature section to acknowledge consent to the contract. Reason A is not correct. Only the proposed insured signing is incorrect because the policy owner must also consent when not the insured. Reason B is not correct. Only the policy owner signing is incorrect because the proposed insured must sign to verify personal information and medical questions. Reason D is not correct. Including the beneficiary is incorrect because beneficiary consent or signature is not required on the application. Question 14. A producer collects the applicant's initial premium and issues a conditional receipt that specifies a medical examination is required before coverage is effective. Under the terms of this receipt, coverage will begin on which date? A. Date of the medical examination, if scheduled under the receipt. B. Date of application, regardless of the exam requirement. C. Date on which the insurer formally approves the application. D. Date the policy is delivered to the applicant. The correct answer is A. When a conditional receipt includes a requirement for a medical exam, coverage begins on the date of that exam, if later than the application date, provided the risk is approved as applied for, so neither application submission, approval date, nor delivery date triggers effectiveness. Reason B is not correct. Coverage does not begin on the application date when the receipt explicitly defers effectiveness until after the medical exam. Reason C is not correct. The formal approval date is not relevant under a conditional receipt that specifies effectiveness upon exam completion. Reason D is not correct. Policy delivery is later than required. The receipt provides provisional coverage before delivery once the exam is done. Question 15. In life insurance underwriting, which risk classification describes an applicant with mortality expectations below the standard mortality table, entitling the individual to a reduced net level premium? A. Substandard risk. B. Standard risk. C. Preferred risk. D. Declined risk. The correct answer is C. The correct answer is preferred risk because it refers to applicants whose mortality is anticipated to be lower than that reflected by the standard mortality table, qualifying them for a discounted net level premium. Reason A is not correct. This defines substandard risk where mortality exceeds standard and requires a rated up premium. Reason B is not correct. This defines standard risk which pays the full net level premium without discounts. Reason D is not correct. Declined risk refers to applications refused due to excessive mortality, not an insurable classification. Question 16. An insurer is calculating annual net level premiums for a 20-year term life policy on a 40-year-old. The pricing actuary projects a 5% deterioration in mortality experience, a 1% decrease in assumed investment yield, and a 10% increase in expense loading. Which assumption change will lead to the largest increase in the net level premium? A. 1% decrease in assumed investment yield. B. 5% deterioration in mortality experience. C. 10% increase in expense loading. D. 1% increase in assumed investment yield. The correct answer is A. This option is correct because assumed investment yields directly affect the discount rate used in calculating net level premiums, and even a small decrease in yield increases premiums more than comparable percentage changes in mortality or expenses. Reason B is not correct. A deterioration in mortality increases premiums but has a smaller effect than a drop in investment yield, because discounting has greater leverage on level premiums. Reason C is not correct. Higher expense loading raises premiums, but the magnitude of premium change from expenses is less than the impact of a change in interest assumptions. Reason D is not correct. An increase in assumed investment yield would reduce rather than increase the net level premium. Question 17. Which of the following financial obligations is most appropriately insured using a decreasing term life insurance policy rather than a level term policy? A. Final expense planning where the need remains constant over time. B. A mortgage with a balance that declines according to an amortization schedule. C. Funding a business buy-sell agreement with a fixed payout amount on the owner's death. D. Protecting a family income where expenses are expected to stay the same throughout the term. The correct answer is B. A decreasing term life insurance policy features level premiums and a death benefit that declines over time, matching obligations like a mortgage with an amortizing balance. Reason A is not correct. A need that remains constant is best matched by a level term policy, not a decreasing death benefit. Reason C is not correct. A fixed payout requirement calls for a level term policy since the death benefit must stay the same. Reason D is not correct. Stable family income protection requires a constant death benefit, which is provided by level term policies. Question 18. Kim and Alex have held an annual renewable term life policy with a level death benefit for 5 years and have observed that their renewal premiums have risen each year despite stable health profiles. Which factor primarily explains these increasing renewal premiums? A. The policy's level premium guarantee expires after the first year, requiring new underwriting terms. B. Renewal rates are adjusted each year to reflect changes in insurer overhead costs. C. Mortality charges escalate annually based on the insured's attained age. D. Each renewal includes a built-up cash value that increases the premium requirement. The correct answer is C. The correct answer is that annual renewable term premiums increase each year because mortality charges rise as the insured's age, even though the death benefit remains level. Reason A is not correct. This policy has no guaranteed level premium beyond each one-year term, so it is not a lapse of a multi-year guarantee but age-based pricing. Reason B is not correct. While administrative costs matter, the primary driver of annual renewable term premium increases is age-rated mortality costs. Reason D is not correct. Annual renewable term policies do not accumulate cash values, so no added cash value can drive premium increases. Question 19. Maria purchased a 20-year level term life policy with a return of premium rider. Assuming no death benefit was paid during the term, what will the insurer return at the end of the 20-year period? A. An automatic conversion of premiums into a paid-up whole life policy. B. The policy's face amount is a lump sum payment. C. A cash surrender value based on accumulated net premiums. D. All term premiums paid without any interest credits. The correct answer is D. The correct answer is that a return of premium rider refunds all level term premiums paid at term expiration without interest accumulation or cash value growth. Reason A is not correct. The rider does not convert premiums into a paid-up whole life policy. Reason B is not correct. The face amount is payable only on death, not to a living insured under this rider. Reason C is not correct. Term policies with return of premium riders do not build a cash surrender value. Question 20. Which method is used to determine level annual premiums for an ordinary whole life insurance policy by allocating early premiums to build reserves that offset rising mortality costs in later years? A. Retrospective net level premium method. B. Prospective net level premium method. C. Aggregate premium method. D. Equity indexed premium method. The correct answer is B. This option is correct because the prospective net level premium method calculates a net single premium allocated over the policy duration using mortality and interest assumptions prospectively to maintain level premiums. Reason A is not correct. This method calculates reserves based on premiums already paid rather than allocating future costs prospectively. Reason C is not correct. This refers to pooling multiple policies' premiums, not to designing level premiums for a single whole life policy. Reason D is not correct. This adjusts premiums with market indexes and is unrelated to the level premium design for ordinary whole life insurance. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.